When running a company, it's critical to evaluate not only your performance, but your competitors as well. Analyzing the simulation report every round is the key to that process. Simply put, if you're not diving into the report to debrief, then you're missing out on key information that can improve your company's decisions and results. In this video, I'll walk through three fundamentals of an effective debrief, highlighting key areas and metrics that you'll want to investigate. These fundamentals are emergency loans, sales, and finally, profits and contribution margins. Each of these metrics will tell a story. You'll need to be able to dig deeper into the data if you want to understand the story being told. We'll start with emergency loans. When you see an emergency loan for your company or for one of your competitors, it's important to evaluate the reasoning. There are two main culprits for emergency loans: lack of financing, making operational investments without properly funding those efforts, and too much inventory, companies producing more than they can sell, resulting in unexpected and expensive inventory carrying costs. Let me show you what these look like in the report. Here on page 2, you can see who received an emergency loan by scrolling across this row right here. Andrews, in this case, has a roughly $17 million emergency loan, and it looks like Baldwin took out a much smaller $2.5 million emergency loan. We're going to investigate these two, figure out the source of their problems. First, we'll check out the cash flow statement on page 12. The question you're asking here is, did they make plant improvements, and if so, did they finance them? To answer that question, we're going to look at this net plant improvements line, where we can see that Andrews invested over $26 million into their plant this year. Okay, did they finance these improvements? Looking down the cash flow statement, we can see that Andrews borrowed $0. On the other hand, Baldwin took on a smaller investment, investing almost $7 million in plant improvements. But if we scroll down, we can see that they effectively financed those decisions by borrowing long-term debt and also some cash from current debt, a total of $7 million that covers their net plant improvements. So, what does that tell us about the emergency loans of Andrews and Baldwin? Well, we discovered that Andrews didn't fund their plant improvements, their major plant improvements, resulting in a big emergency loan and an expensive lesson. In the future, they should look to borrow to fund their plant projects. Remember, if you see a negative projected cash position on the finance page, that should be a big red flag. But as for Baldwin, their emergency loan is because of something else, and it's actually the most common culprit, having too much inventory. You can start to see that story here if we go up a page to the balance sheet, with Baldwin showing a big inventory cost on this line. We can investigate further by looking at the production section on page 10, specifically the plant information table. Now, carrying some inventory is a good thing. That means you avoided a stockout. You didn't run out of product that your customers wanted to buy. We usually recommend carrying about 10 to 15% of sales as a good benchmark. If we look at Baldwin with their product Baker, you can see that they have a lot of inventory for Baker, 1,420 units compared to their total sales, less than 3,000 units. That's way over the 10 to 15% inventory recommendation. Now, what this tells me is that they likely expected to sell much more than they actually did. So, that means not only did they generate less sales and revenue than they expected, now they have to pay to store all of that product. Inventory comes with a 12.5% carrying cost, and all that inventory for Baldwin, product Baker, led them to running out of cash and getting an emergency loan. So there you have it. We looked into two emergency loans and got to the bottom of why and where they came from. If you get an emergency loan, look for financing and/or inventory issues. Understanding why will help you make better decisions in the following rounds. The next fundamental to look at when debriefing the report is sales. Are your product sales matching your expectations? When you compare your sales to the industry average, you'll want to ask the question, are my sales lower or higher than average, and why? When analyzing sales, there are two main factors to consider: availability and product design. Did we stock out? Did we offer products that were well matched to our customers' expectations? Here's how you can investigate your sales in the report. First, let's look into stockouts. This means you did not produce enough units of your product and you ran out. We'll go to page 4 and take a look at the low-tech USA market for this example. Here in the top products table, you can see every product that's sold to the USA low-tech customers. This column will show us which products stocked out. We can see that Days, Eat, and Able all ran out of units to sell. The next thing to look at is this column to the left, potential sold. This quantifies how much each product deserved to sell if there were no stockouts. Take a look at Able. It deserved to sell 664 units. In reality, with its stockout, it only sold 366. You can see this visualized in the actual versus potential units sold chart right here. The Andrews Company missed out on sales it deserved, and this benefited their competitors. For example, Baldwin's product Baker picked up an extra 135 units sold on top of what they deserved to sell. So, by stocking out, Able missed out on revenue and handed it to its competitors. If you run into a situation where your sales are low, it's important to check to see if you're meeting your sales potential. Understanding what you deserve to sell is helpful when developing sales forecasts for the next round. The next way to dig into sales performance is to evaluate customer satisfaction. We'll go to the Germany low-tech market on page 6 for this example, but the principle applies to any customer segment that you're evaluating. Each segment page has this top products table. And in addition to the actual and potential sales, it has tons of useful information about all the products being sold in that segment. It's got price, age, speed, and accuracy specs. But all the way to the right is this customer satisfaction score. The customers were nice enough to rate all of these products at the end of the year, so we can get an idea on how well each product met their expectations. This is a great opportunity to do a competitive analysis with your product, comparing it to the other offerings in the segment. If we look at Andrew's product, Able, you'll see that it has a low customer satisfaction score of 9. Now, why is this? This score will be influenced by how well our product met the customer expectations. We can see if we scroll up, for this market, the most important spec to these customers is price. They've got it at a 50% importance. They're very price sensitive. If we look back down, Able has a price of $34.50. If we compare that to the best product in this segment, Eat has a customer satisfaction of 18. We see that Eat has a price of $32.25, significantly cheaper than Able. So it's more appealing to the customers. If we continue down the customer expectation list, we see that positioning is the second most important, 21%. They're looking for a product with a speed and accuracy of 5.8. Let's look at Able. Able has a speed of 6.6 and an accuracy of 6.6. Let's compare it to Eat, 5.7, 5.7. It's no wonder that Eat sold more than Able. It's better designed to meet the customer's buying criteria. So, when you analyze sales, pay attention to the customer satisfaction score. They're going to tell you which product they prefer based on the highest number. Product design that meets customer expectations is at the core of competitive sales. To summarize, if your sales aren't meeting your expectations, the report will help you uncover potential issues with availability, stockouts, and/or product design. The next fundamental for analyzing your results is digging into profit and contribution margin. How much were your efforts actually generating in terms of your bottom line? Profits have a direct relationship with contribution margin. If your company has low profits, or even a net loss, this is typically due to low margins. It's important to be able to identify what a healthy margin is and to evaluate your pricing and variable costs when you're looking to improve your contribution margin. Here's how to do that in the report. Let's start on page 2, identifying teams with low profit. Here, we can see that Andrews and Baldwin are the two companies that are struggling the most. For Andrews, the main problem was very low sales. But for Baldwin, their low profits are the result of a low contribution margin. This is often the case when investigating profit issues. Baldwin has a contribution margin, here we can see, of 12%. Generally, you're looking to have a contribution margin of 30% or higher. To look into Baldwin's contribution margin problem further, let's go back to page 10, where you can see a breakdown of products in the costs table. This will help us diagnose the issue and identify the best way to address it. Take a look at Baker. It's got that 12% contribution margin. This is driven by price and variable costs, broken down in the columns left of contribution margin. Baker's variable costs, adding together material, labor, and shipping and defect costs, are roughly $21. That's how much it costs to make 1 unit of Baker. And they're selling it for $26.25. So $21 to make it, $26.25, that's not an effective margin. Add in the inventory costs that we talked about earlier, This product is not set up to generate healthy profits. So, how can Baldwin address this? When attempting to improve margins, there are three primary options to consider: raising price, reducing material costs by lowering the product's service life, or reducing labor costs by investing in automation. At a glance, it looks like Baker's generally competitive when it comes to labor. $10 is not out of the range of what other products are spending on labor. Same goes for material. At roughly $10, that's similar to some of the competitors that we're seeing on this cost chart. It is probably smart to start driving those down, but neither of them are the glaring margin issue. That would be price. Compared to every other product being sold, Baker is priced significantly lower. Nobody else is offering a product below $30, and Baker is at $26.25. So, even though the customers that Baker is targeting are price conscious, there's plenty of room to bump up what Baker is selling for, improving its margins, and still being an industry leader in price. In summary, consider your company's overall and product level contribution margins. Are they over 30%? If not, identifying how you can effectively improve your margins will help generate better profit numbers going forward. So there you have it. Three important topics to investigate when debriefing your results in the simulation report. Remember, diving into the report and understanding the what and why of previous rounds will help you make informed, effective decisions going forward. Good luck.